Okay, hello everybody. Good morning from Sharesight. My name is Doug Morris, and I'm the Sharesight CEO. Thank you to everybody for joining us today on the webinar. Just a reminder that this webinar is being recorded, and there will be a Q&A session at the end. So just as a matter of housekeeping, if you use the Q&A function within the webinar, I will circle back after the presentation, and we'll go through the questions. So I'm joined today by Hugh Lam. And the title for the presentation today is Going for Gold, How to Invest in and Track Precious Metals. Thank you very much for joining us today, Hugh.
Thanks for having me, Doug.
Sure. So just a little bit of housekeeping on our end. Please be advised that Sharesight does not have an AFSL. We're a software company, of course. And so anything you hear in today's presentation should not be considered investment or tax advice of any kind. Please always check with a professional if you do have questions of this nature. So our agenda today. So what Hugh will cover is the role of gold and precious metals as defensive assets in the current economic climate. This is a rather topical webinar given what's been happening with the gold price and certainly some of the scenes we've been seeing around Sydney in Martin Place specifically. Also a practical comparison of different investment options, so physical bullion versus gold ETFs and also mining stocks. Expert insights on allocating precious metals within a diversified portfolio. And then we'll finish with Q&A. So I'm personally really looking forward to this presentation. And so with that, Hugh, I will turn it over to you.
Thanks very much for the kind words and introduction, Doug. Yes, I'll share my screen and we'll get started. Right. So yeah, my name is Hugh Lam. I'm an investment strategist at Betashares, and again, just want to reiterate, I'm really keen and excited for this webinar today, where I'll talk about everything related to the yellow metal gold. It's increased in price quite rapidly this year, but it has also been around for many decades. So before we delve into the breadth of this presentation, I've also got my own disclaimer slide. So again, all information in this webinar should be considered general advice in nature only, and it does not take into account any person's financial objectives or needs. Just a little bit about Betashares for those who may or may not have heard of. Betashares is one of Australia's leading ETF issuers on the market. We've recently passed $60 billion in assets under management. So that's a really big milestone for us. And we also have over 90 available ETFs on the ASX. We have a very wide range of products available for all types of investors, from young accumulators to our retirees. But I think most importantly, that statistics to the right, 1 million investors is the one that we're most proud of. 1 million Australian investors entrust their capital with us. And that's something that we take a very great deal of pride in. So that's a little bit about Betashares and who we are. I know that Doug has mentioned a little bit of an agenda. I've got a few other points that I wanted to talk about in regards to gold. There are 5 kind of main points here. The first one, I wanted to go back to basics and really talk about gold's role within a portfolio. What are key characteristics that gold has, from being a safe haven asset to being an inflationary hedge. And then we'll look at gold's performance over the decades, just to give us a bit of numbers and evidence that gold really does have a safe haven asset role within our investments. And then thirdly, I'll talk about some of the recent trends that we've seen in gold's price this year. Again, we'll touch upon gold within that portfolio perspective. And then finally finish off with how you can actually gain exposure to gold. There are lots of different ways that you can purchase gold, whether that's lining up at the ABC Bullion, getting that physical gold. But of course, there are also gold ETFs out there, which I'll be talking about, given Betashares is an ETF issuer. So that's a little bit of a lay of the land. I'll jump into the first sort of slide here. Which is about these furry animals. So I'm not sure if you guys have come across these, but these little furry toys on the left-hand side are called Labubus. And they were extremely popular during the summer, the Northern Hemisphere summer, so June, July, August. And it was a phase, and that phase has now gone. but it was very popular for a given amount of time. And, we're almost seeing that with gold recently. So as I've mentioned, we've seen lines outside the ABC bullion in Sydney, as you can see here on the right-hand side. So some crazy scenes that's popping up, but also people on the street are bringing up gold. Search interest in gold online have also picked up too. And so the biggest question that I want to unpack here today is whether the run up in gold's price today is a reflection of the shifting world order that we're seeing ourselves in. All the sort of geopolitical uncertainty that we're seeing around the world, rising budget deficits, sticky inflation, a weaker US dollar, is that all reflected in gold's price, or are we actually in a bubble? That's really the key question here that I wanted to unpack today. But I guess to start off with, I mean, I think a good starting point is again back to basics. Like, where does gold fit within that portfolio perspective? What are the key characteristics that gold can bring to our investments? For the uninitiated, I might just start off with, why people buy gold in the first place. As I mentioned, gold has been around for centuries. It's been through many governments, religious entities, etc. So people know gold. It's been used in jewelry, industrial usage as well, and in things like electronic components. And so, those sort of industrial uses, that accounts for about 40% of gold's demand. The other 60% is actually for financial use. So things like central banks purchasing gold is one factor, inflows into gold ETFs, and also in bars and coins as well. So that financial usage is quite a strong driver of gold's price. So that's just to set a bit of background as to who buys gold in the first place and why they might do it. Now, I've got three sort of key characteristics of gold. First one is a safe haven asset. As I've mentioned, gold has been around for centuries, and people tend to flock back to the yellow metal when there's periods of crises. And we'll see that in the next slide, where we'll look at recessions over the past 5 decades and how gold has performed during those periods. Diversification, gold tends to be negatively correlated with stocks in extreme market sell-offs. So what does that mean? It means that, if we do have a sell-off, as we've seen during the COVID pandemic and GFC, stocks fall, but generally gold rises in that scenario. So when you blend the two, you can reduce the overall level of portfolio volatility that you might experience. So that's a great sort of benefit of having something like gold within a portfolio. And then finally, inflation protection. Gold is known to maintain its purchasing power over time. And the reason why is because the supply of gold increases very, very slowly over time. About 1 to 2% of gold's output increases annually, and a lot of that is recycled gold anyway. Compare that to something like fiat money, and that's just paper money. Central banks can continue printing and printing money. So when you've got more money in the system, that decreases the value of something like the US dollar, the Australian dollar, the Japanese yen, if that printing occurs too much. So that's where gold as an inflationary hedge fits into the picture. So those are really three key characteristics that gold has within our portfolios. And I think it's something that, we should always remind ourselves on when we're thinking about gold within a broader portfolio perspective. So that's a bit about gold's characteristics. I'll move on to gold's performance over time since the 1970s. So as I've mentioned, if you look at the left-hand side of your slide, we'll see that these are a few recessionary periods over time, all the way to the 1970s. So as I mentioned before, gold tends to rise during these periods, and we can see that here during COVID in that first row there, GFC, and also the dot-com bubble. We saw gold rise when the S&P 500 fell. Obviously, that this isn't a causality that happens all the time. Sometimes this relationship falls, such as what we saw during the 1990 to 1991 period, when the US had a resolution during the Gulf War. And so we actually saw gold sell off while the S&P pick up. But for the most part, we can see that during these periods, gold tends to perform quite well. And so another period was during the 1973 to 1975 period, For those who are a little bit older and know their history, we had an oil shock crisis that led to persistent inflation, and we saw gold increase 50% on an annualized basis compared to a fall of 16% in the S&P 500. So again, gold does have that role as a safe haven asset. And we can also see that reflected in key milestones that it's hit over time. If we think about the $1,000 level, when did that hit? Well, we actually hit during the 2008 GFC when Bear Stearns collapsed, as we can see here. During the COVID pandemic in 2020, gold hit $2,000, and more recently, it hit $3,000 as the April Liberation Day tariff announcement caused a little bit of jitters around the world. And there's probably not enough real estate on the screen, but gold also reached $4,000 just earlier this month when the US government was sent into lockdown, and it still is in shutdown, which is the second longest today. So the natural question is, where is the next movement in gold here? We can see that meteoric rally in gold in 2025. And it comes back to my main question that I posited at the start of this webinar, whether the rally in gold we've seen today is a true reflection of the shifting world order that we're seeing ourselves in, or whether this is a bubble. But again, the key sort of point for this slide, at least, is that over time, gold really is that safe haven asset. It tends to perform well during inflationary periods, as we saw during the 1970s here, and also has a diversification benefit to investor portfolios. So let's move to what we're seeing this year. So just to give a bit of context, in 2024, gold returned about 27.5%, not bad. It was one of the best performing asset classes just behind Bitcoin. But this year, gold is up nearly 50%, which is an insane amount to think about. To give a bit of context, the S&P 500 is up about 14%. Other markets around the world have done even better than that. But yes, as I've mentioned, gold is up nearly 50%. So what's really driving gold's price this year? I think to give a bit of a framework, I've split this up into some key structural drivers and some cyclical factors as well. So on the left-hand side, you can see I've split the structural factors into three parts. One of them being geopolitical uncertainty, second being central bank demand, and then thirdly on inflation and deficit concerns. More on the cyclical side, typically a weaker US dollar, lower interest rates, and even momentum can influence gold's price in more the short to medium term. So that gives us a bit of framework to explain what's happening. So let's start with the structural factors on the left-hand side, geopolitical uncertainty and central bank demand. I guess with this first part on geopolitical uncertainty, of course, we've seen a lot of concern around Trump's tariffs and whether that would cause inflation and slow economic growth around the world. Whilst there have been concessions made between US and China trade counterparties earlier this week in regards to soybean purchases and rare earth exports, there's still a lot to be discussed. And we'll see that during today's meeting in South Korea, where Trump and Xi will finally meet in years. And so there are a lot of key national security concerns that still has to be met. For Trump, that's renationalizing supply chains back to the US. And for China, it's really about how can they continue to advance their technological ambitions if NVIDIA continues to curb exports under the influence of Trump's administration. So that's still a lingering concern, despite the concessions that we've seen earlier this week. Second is on central bank demand. And for that, I've got a great picture just to show that trend over time. So this picture is from the World Gold Council. It shows the rolling 4-quarter central bank net purchases. So we can see here that it's been relatively sort of stable since 2015, but we saw a huge ramp up in 2022. Now, the biggest question is what drove that? You can see a big arrow there where Russia invaded Ukraine in early 2022. As a result, what we actually saw during that period was that the US froze about $300 billion worth of Russians' foreign reserves. So what that effectively showed to the rest of the world was that if your reserves are held in dollars, not really yours to begin with. They can be seized, they can be locked up, and pretty much be turned off with a click of a button. And so countries around the world, typically emerging market nations, were like, okay, well, if I have a question, if you can do that to a nuclear power like Russia, what happens then if we disagree with you next? And so this whole trend led to a loss of trust in paper assets, paper, fiat currency, etc. And we saw this huge ramp up in central bank demand since then. Over the last 3 years, we can see at that 1,000 level that central bank demand has averaged out to be around 1,000 tons over the past 3 years. So central bank demand has been a very strong structural driver of gold prices in recent years. And let's see who's buying that. Again, this is pulled from the IMF. We can see that the sort of top 5 countries, again, are all emerging market nations led by Poland, Azerbaijan, Kazakhstan, China, and Turkey. So again, this is really all feeding into that narrative that emerging markets are, seeking, solid physical commodities that can hold the value over time, as opposed to holding something like US Treasuries. And I've got a chart later that will show that trend where gold is becoming a bigger portion of countries' foreign reserves in recent years. So yeah, this is just a chart showing that central bank gold accumulation year to date. Now, the other structural factor is on inflation and deficit concerns. We know that if countries continue to spend a lot of money, that's typically going to lead to rising budget deficits and sticky inflation. If you print a lot of money, that tends to decrease the value of that paper currency, and it makes precious metal commodities like gold a little bit more attractive. And so, again, I've got a chart here just to talk to make it a little bit more visually appealing. This shows the G7 nations' government gross debt as a percentage of their GDP over time since 2001. You can see that genuinely that's been trending over time, but we saw a pretty strong uptick during COVID. So if you see here all these sort of sharp bumps during 2020, that's all due to these countries having to prop up their economies when their nations were effectively shut down due to the pandemic. Just to give a bit of scale, the US spent about $5 trillion in cash in order to prop up its economy, and that's a huge amount of money that's led to quite persistent deficits right now. But there are also other structural factors as well underneath the surface. We're seeing aging populations across these advanced developed nations, and when you do see that, that's obviously going to put pressure on the government coffers through rising pension costs and healthcare costs. For example, in countries like Japan and Italy, we're seeing social security spending exceed 20% of their GDP. So that's a huge amount, and that's going to be a very big burden on their budgets. And as a result, all that spending, if not directed to the right places of the market, is going to lead to slowing growth and productivity. Now, just to throw another thing on top of that is that we're seeing rising interest rates creating huge interest burdens on already elevated debt loads. We saw during 2022, interest rates rose quite rapidly. And as we know, if you've got any type of debt, if the interest rate increases, then your interest expenses will also have to increase too. Now, we're not talking tens of thousands of dollars like our mortgages. We're talking billions, if not trillions of dollars that these governments need to service. And so all of this provides quite an attractive backdrop for something like gold that holds its purchasing power over time. So that's really a few key structural drivers of gold's price that we've seen over recent years. But we've also seen a few cyclical factors as well. I've mentioned the weaker US dollar. All of those factors I've mentioned before, that geopolitical uncertainty, that inflation deficit concern, that's led to weakness in the US dollar, which has come off quite a bit this year. And why that's supportive of gold is that because gold is priced in US dollars, that tends to make it more affordable for international buyers who purchase in other currencies. Again, the biggest question is whether that weakness in the US dollar is here to stay. And again, I've got a chart here just to show that movement in the US dollar index versus gold's price since 2022. And we can see here that generally we have that inverse correlation that when the US dollar spikes significantly, gold tends to be a little bit weaker. But the biggest question is, if you look over that period, the movement in the DXY or the dollar index has been relatively stable. And the question is whether we will continue to see weakness in the greenback from here. Now, that other chart I mentioned, this is from the IMF as well. It's an interesting chart that shows that the percentage of foreign reserves in gold is picking up over recent years, as I've mentioned, and it's nearly touching that of US Treasuries. So soon, we might see global central banks holding more gold than US dollars. Now, does that mean the US dollar is effectively dead from here? Not necessarily. I mean, the US dollar is still an important function of global foreign exchange transactions. There's about $7 trillion in US dollars in the market, and it's used to price a lot of transactions between other nations as well. But again, that kind of leads to my final point here in terms of gold's movement. Where to from here for gold? Again, there's a lot of moving parts, as I've mentioned. We're in that shifting world order with a lot of uncertainty. But, there are factors that might push gold to the downside, as we've seen in recent days. If Trump and Xi carve out a deal today in South Korea, that could send gold a little bit lower. And concerns around Fed independence, where we saw Trump try to fire Lisa Cook, has abated because her position in the Fed has remained. And so there are a lot of questions here, but I think for us, all of those sort of structural and cyclical factors, if they're here to stay, then that should provide a bid for gold. It's very hard to make a forecast as to gold's price movement from here. But if we look at the fundamentals at central bank, what we're seeing is central bank buying remaining resilient. And if Trump is in office for another 3 years, again, we don't know what to expect from his economic policies. So there are sort of a lot of balancing movements here. Now, the final sort of part I wanted to touch upon was on building gold within portfolios. I know a lot of you on the line have existing investments in other stocks or bonds as well. How does gold fit within that picture? So I've got a nice example here. The pie chart on the left shows a pretty traditional 60-40 portfolio, 60% in stocks, half and half Aussie and global, and the other 40% in Australian government and corporate bonds. What I've effectively done to that 40% allocation is reduce that by 5% to about 35% and have a 5% allocation to gold. Now, what you can see here is that over this 10-year period to the end of 30 September, we've seen the returns increase marginally, seen the volatility of our portfolio decrease as well. And so what that means is that our risk-adjusted returns, which is returns adjusted for risk, increases. So that's this thing here called the Sharpe ratio. We see that the Sharpe ratio has increased marginally. And we ask ourselves why. It comes back to those key characteristics that gold has. It's a diversified, typically is negatively correlated to equities. And so it smooths out that volatility, but can provide enhanced return potential as well. In terms of allocation to gold as a percentage, we typically advise, a weight that's, relevant to your strategic asset allocation and the objectives that you're attempting to seek, in terms of retirement or accumulating a deposit for a house. So it really depends, but generally gold is viewed as an alternative asset class, and it'll typically have a smaller weight to something like equities and bonds. So that's a little bit about how gold fits within portfolios. And just to round off, how can you access gold? There are a lot of different ways. You can wait outside at the ABC Bullion in Martin Place and buy physical gold in your hands, But you don't have to line up. There are other ways you can buy gold. There are things like gold certificates and derivatives. But here I'm going to talk about ETFs, just being an ETF issuer. Again, ETFs are a great, transparent, cost-effective, and highly liquid way to access the price of gold. So here are just three examples from our suite. We've got QAU here, which is a gold bullion currency hedged ETF. So it's backed by physical gold. MNRS, which is a global gold miners ETF. So this provides exposure to equities, global gold miner equities. And then finally, we have an interesting one, which is ROY or ROYL, which is the Betashares Global Royalties ETF, where a decent portion of the portfolio has some gold miners in there that earn royalties through their operations. So that's a high level overview of the different ways you can invest in gold. Of course, there are things to consider when investing in something like gold. So I'll just leave that up here. But that really wraps up the presentation here today. And I'm ready to take any questions that you guys might have.
Thank you very much, Hugh. That was good. Lots to think about in there. I'll just go to the questions now. Got one here. Please, everybody submit your questions to the Q&A function of the Zoom webinar. This person has remained anonymous, but they've said physical gold can be used anywhere in the world at any time. So if banks and share markets were not accessible, huge hack or something, or money no longer worth anything, gold has been a currency since before money, basically. That is interesting, and I think that kind of gets to gold is almost this esoteric kind of concept. And I've had many arguments with investment analysts and economists about gold and whatnot. And it gets quite heated because I think conceptually people struggle with gold as almost being like almost a doomsday backup. Is that
Yeah.
right?
Yeah, I mean, it's always been viewed as a doomsday backup. I think that generally when gold appreciates this much, investors might be a little bit concerned as to what's wrong with the current market conditions that we're finding ourselves in, and I think that that's a healthy question to ask. Rather than seeing gold's price rise and joining in on that FOMO, I think a healthy dose of skepticism is healthy. And what we've seen is that gold has pulled back to about 39.50.
Mm.
And again, that is a pretty healthy pullback in my opinion, just given that if gold is up 50% year to date, a pullback of about 5 to 10% almost makes sense. But again, it comes back to my key question. Is the rally that we're seeing today a reflection of a changing world order that we're seeing? If it is, then gold's price level makes sense. If it isn't, then yeah, we might be in some more speculative territory. I
Yeah.
think that there's probably a good mixture of both. But yeah, as I've mentioned, it's a bit difficult to forecast gold's price from here. But if you understand some of the key drivers on both sides, then that's good to know.
Mm. Got a few more questions that have popped in. This is one I had as well. I'll get to the Bitcoin comparison in a moment. People don't worry because I also had that question. But CB is asking, do you have any comments on the gold to silver ratio? And I must admit, I think of silver when I think of gold, and I wonder, well, why not silver? What's going on with that metal as well?
Yeah, silver's an interesting one. We've actually seen silver's price rise quite significantly in relation to gold this year. So we have seen similar moves. And I think what that is a reflection of is probably the tariffs on some metals that we've seen by Trump earlier this year. And so what we saw was a squeeze on silver inventories over the past few years. And when you see supply of any type of metal, you'll see prices go up. So that might just be a reflection of corporations trying to front load silver
Mm,
supply because silver is used in a lot of industrial uses. But I think the key difference between gold and silver is, silver is probably a little bit more leveraged to the economic cycle. It's used more in industrial uses, as I've mentioned. But gold is typically viewed more of that, more of a precious, rare sort of metal.
mm,
And so that's probably the key difference. I mean, people have used a gold to silver ratio in various sort of situations, whether that's to to time sort of entry points into one metal or the other. I don't personally have a strong view, but what I have seen is that the gold to silver ratio has generally increased over the past 2 decades. There have been ebbs and flows throughout that time, but structurally, gold's price movement has been stronger than that of silver. So that ratio has trended slowly upwards over time.
Mm,
Now,
mm,
is that a reflection of, again, that world order that we're seeing? Potentially. But yeah, gold and silver have very different uses, and I think it's important to tease that out.
mm. It is interesting that slide you showed about the convergence with the gold and U.S. dollars or treasuries. I think
Yeah.
there's a lot talked about around, when will the reign of the U.S. dollar be over in terms of the world's safe haven
Yeah.
and so
Yeah.
forth. And I think in most people's minds, you think, okay, well, if it's not the USD, is it the euro? Is it the yen? It's
Mm.
almost like you kind of go for a one-to-one comparison. When in fact,
Yes.
maybe what we're seeing is gold is almost the sort of the temporary bridge, and it's going to just separate out from there, perhaps.
Yeah, that's right. And I think just to give a bit of a counterbalance and just to give our viewers a more balanced view on gold, I'm not spooking myself as a gold bug necessarily, but that chart there also includes the gold's price movement. So, if you
Okay.
stripped out the movement of gold's price, and if you looked at the actual underlying units or holdings of gold, that chart might look a little bit different.
Mm.
But that really is a reflection of both the quantity of gold and the price of gold. So that's kind of naturally gone up, whilst US Treasuries as a percentage of foreign reserves has come down.
Yeah.
That's not to say that you know the case for gold isn't there. I think that all of those structural factors that I mentioned are still leading to that increase. But yes, there should be a healthy dose of balance to those views.
Okay, well, there's been about four questions around, gold versus Bitcoin. Will Bitcoin replace gold? I want to sort of share something that I have on my side very quickly, just to show something that I whipped up just before the webinar.
Mm.
This is our drawdown risk report in Sharesight, and I promise this is not a shameless product plug. I found this fascinating. What this shows is the maximum price drawdown, which is on the horizontal axis, versus the return, which is the vertical axis. This is just the hypothetical Aussie portfolio. You can see gold is top left quadrant, which is exactly what you want. And the return in this case since 2021 has been 36% per annum with a drawdown of only 12%. And then if you go over here to the far right side, that's Bitcoin. So you've got a return of 11.76% and a drawdown of 74%. And so I guess the question really that I'm trying to, collate questions from the audience here is, will Bitcoin replace gold? Do you think that that's a possibility?
Yeah, it's a pretty interesting question, and I think that investors tend to lump gold and Bitcoin together because it's reflecting this whole debasement trade theory that we're seeing in markets recently, and what that effectively is a loss of confidence in fiat currency like the US dollar into things like gold and Bitcoin where supply is relatively scarce. I don't necessarily think that Bitcoin is going to replace gold. As I mentioned, gold has been around for centuries. It's more so that Bitcoin is a newer entrant into the market. But what I think it does represent for investors is a broader opportunity set for them to express their views on the world order that we're seeing. I think it gives investors different avenues
Mm,
to invest in the digital aspect of things, being Bitcoin, and also more traditional avenues as well, gold too. Now, the price returns of gold and Bitcoin are quite different as well. So as I mentioned, gold's price tends to be related to what we're seeing during periods of recessionary periods, inflationary periods. Bitcoin, to a certain extent, does do that, but it's more so leveraged to the liquidity cycle. So what that means is if we see metrics like the M2, M3 money supply increase, we actually tend to see Bitcoin's price movement follow quite closely to that. So Bitcoin to me, and from what I've seen on the charts, is that Bitcoin is more closely correlated to the liquidity cycle. So if we
mm,
see liquidity improve in the market, then Bitcoin does well. Gold isn't as leveraged to that same cycle. So there are very
mm,
different return drivers for both asset classes. But at the same time, they're representations of this debasement trend that we're seeing here. So there are a few nuances when unpacking gold and Bitcoin, but to answer your question, I don't necessarily think gold will replace Bitcoin.
Yeah.
Bitcoin will replace gold.
And Bitcoin's certainly more volatile as well than the gold price, right?
Yes, and that's right. And it's because it's been in the market for, not as long as
Right.
gold.
So inherently
But
it would be more volatile.
yeah, but what we've seen is that the volatility of Bitcoin has compressed over time as
Mm,
it's become more institutionalized,
mm,
uh, pro-friendly regulation, such as the Genius Act that we saw earlier in the summer of this year. That has all been quite supportive of Bitcoin prices and in moderating that volatility. For example, I mean, AMP in Australia has become the first super fund or institutional investor to start buying Bitcoin. So again, all of that
mm.
factors leading into probably a little bit more adoption within the space and more comfort as well.
Yeah, yeah. I've got a question here from Sarah saying, how should we consider gold we already own? Um, well, do you have a view on that, Hugh?
I assume I assume the god that is you already have is a physical god. In that case, I mean it is gold at the end of the day, but there are a lot of factors when holding physical gold. It's
Yeah.
you got to carry it around. It's not as portable. You got to exchange it at
Insure it,
a
maybe.
bullion. Insure it, maybe
Yeah.
exactly right. So there are a lot of storage costs,
Mm,
insurance costs as well that you need to consider. But as I've mentioned, the proliferation of ETFs and gold ETFs provides you access to the price of gold. It's very cost effective. You don't have to insure it. You don't have to carry around your gold ETF.
hmm
It's all on your brokerage platform like Betashares Direct. But yeah, that's probably my view. I think
Yeah.
that physical gold is gold, but you
Mm,
do have to carry it. You do have to store it. You do have to insure it as well.
yeah.
So just
And
want to keep in mind.
I would also say, you can add that to Sharesight as well. We offer the tracking of metals on
Yes.
the platform
Yeah.
now. So it's essentially you can put it in ounces as a couple other
Yeah.
options as well. So just record it in there, so at least you have it tracked, so you can assess the performance of it, based on what Hugh has shared
Yeah.
here today. Um, this is a very good question. Who controls the world gold price? Historically, USA/UK and paper derivatives seem to impact it, but will China
Mm.
have more impact with their big reserves going forward? That's a fantastic question.
Yes, it's a really great question. And again, it boils down to those key drivers that I mentioned at the start of the webinar. So there are central bank buyers. You've
Mm,
got countries buying gold for jewelry, for bars and coins, etc. What I would agree with is that we're seeing more larger Asian nations being purchasers of gold. So China and India. China and India purchase gold for a lot of reasons, but the biggest one is also for religious purchases as well.
mm,
And so gold in the Chinese and Indian context has been quite important for them. And it's, what you do see is that in jewelry as well, jewelry is a form of almost praise in Chinese cultures. You tend to give gold jewelry to your neighbors or someone that you respect.
mm,
And so that's been a pretty strong source of demand. So I think that there are a myriad of factors, as I mentioned, emerging markets as well are driving up gold's prices. And it's probably more so shifting towards those Asian nations compared to what we've seen in the past.
mm, That's yeah, interesting. Um, Question that I have actually, and it's sort of circled here in some of the questions, is what in the BetaShares ETFs, what the gold bullion ETF, is it literally the asset manager BetaShares going and purchasing physical gold? Is that how that actually works?
It's a good question. So it's not. So with that ETF, which is QAU,
Hmm
there is a gold vendor who actually owns the gold, and that's the National Bank of Canada. And that's those gold bars are held in a vault in London, and that is with the gold custodian being JP Morgan, and so it's not Beach is necessarily going out and purchasing gold. There are a few sort of players involved, as I mentioned, gold vendor and gold custodian. And the great thing again about ETFs is that you have full transparency and look through into the gold that we actually hold. So if you go to the fund page for QAU and you scroll towards the bottom, there is a section where you can find a list of gold bar audits. So we have a list of every single gold bar that's held in the vault in London.
Mm,
And so yeah, there's a lot of look through, and investors can get a lot of comfort that they know who holds the gold and where the gold is held. So
that's
that's a
really
little bit
cool.
of how that QAU fund works.
Yeah, that's fascinating. It kind of
Yeah.
brings to mind one of the Die Hard movies where I think there's a heist on the gold reserves in New York from memory. Um, someone here is asking, is it possible to buy gold from banks? I know in some countries you can buy it
Mhm.
from the bank and they'd actually do the storage for you.
Yeah, look, not it's probably not my domain. I think in Australia, I don't think anyone has bought gold from the bank. That might be probably. Look, what I would say is that in developing nations or emerging market nations, where countries like China are trying to build, their Belt and Road Initiative, they're trying to effectively liaise all these nations to effectively create a new world order that doesn't rely on the US dollar system. So
Mm,
what might happen is that the Chinese nation is effectively trying to increase the profile of its currency, which is the Chinese yuan, and also gold as well. So if they can make that interchangeable, you might see a lot of transactions happening more between the Chinese yuan and gold.
mm,
And yeah, I mean that's something that we're probably looking at from here, and it's a pretty fascinating development. Look, this is probably not in the intermediate term, but it might happen down in medium to longer term. So
mm,
that's what I
mm.
would say.
Yeah. Got a good question here from Carl. Thoughts on gold ETF versus gold miners themselves? That's actually something
Mm.
I was
Yeah.
thinking as you were presenting. Why not just go out and buy a bunch of, reputable gold mining companies, and surely
Yeah.
kind of index that and is that the same thing in terms of a proxy?
It is the same thing in terms of proxy. So gold miners, obviously, their revenues are tied to the gold price. So the natural question is, why don't I buy gold miners? With gold miners, the returns of that basket or that exposure is typically more leveraged to gold. So what that means is, say gold increased, 50% this year, as I mentioned, then a basket of gold miners might return 70% or so. Why is that? Oh, it's because they have operational leverage if they can maintain their costs whilst whilst the gold price rises, that margin expands. Miners are a company, so when your margins are expanding as a company, then the value of your company increases
Mm,
to the market. And so that's where that leverage component comes in. And what we've seen is that this metric called the all-in sustaining cost, which you can find online, or the AISC, has increased over time, but it hasn't increased to the same extent as gold's rise. So what you've seen across these gold miners, and I might mention, high quality gold miners,
mm,
is that the net profit margins of these companies have expanded quite significantly. And so we saw a valuation kick in these names, and gold miners as a proxy has done very well. So I mentioned MNRS, which is our global gold miners ETF. That was the best performing ETF on the ASX in September, the
mm,
month of September.
mm.
And so yeah, I mean it is a proxy to gold. It's just we typically view it probably as a more leveraged sort of exposure to gold's price movement.
And, and just to follow on from that, is there, and I know you're not a mining analyst per se, but I'll put you on the
Yeah.
spot here. Is there lead time risk, in selecting a gold miner? Because if you think about oil or shale or things like that, it's often like it's a great idea. Everyone knows that, but it's like how long is it going to take to get it out of the ground and refine it kind of problem, right? Is the
Yeah.
same thing true in gold?
Yeah, I mean, I think that's true. And I think it comes back to any sort of mining company that if you have exposure to high quality assets and mines, then you're obviously going to leverage more or have exposure to more of that gold. And so that's why I mentioned, those high quality producers where they have operations across various geographies, nice and diversified, because you do have risk if, one mine falters, then you're obviously quite concentrated to that one mining site. And so we typically see that gold producers with high quality assets across different geographies can tend to, have that exposure to gold quite quickly. But yeah, that's probably a trend or theme that, is consistent across miners in general.
Mm, mm. Someone here is asking, how does buying physical gold work with capital gains tax? So I'll take that one. Again, this is not taxation advice. I want to be very clear about that. But gold is subject to capital gains tax if you buy and sell it. So please do keep that in mind. I dare to say that a lot of those folks who are selling their gold in Martin Place maybe not thinking of the tax impact, but you can track that in Sharesight. So again, this is
Mm.
a shameless plug. And someone has asked about how you do this in Sharesight. If you just add a holding to your portfolio, type in gold or metal, and we have all of our new precious metals feeds come in there. It's priced daily. So you can add in units, weight, and what have you, and it'll track the performance. And then you can also run the tax reports for those as well. Um, Maybe we'll end on this one. This question's from Martin, and maybe this is a nice way to kind of recap what you've covered, Hugh. Martin asks, gold normally rises as the stock market dips, but not this time. Why is it rising with the stock markets? And yeah, that is interesting. And I would say like I come from an asset allocation background, and the goal was to find asset classes that perform differently from one another. But
Mm.
what's happening right now?
It's happening because of the structural factors that I've mentioned. So typically, the negative correlation that I mentioned with stocks and gold is because of those more traditional cyclical factors, weaker US dollar, lower interest rates, that tends to support gold. That's exactly what we saw over the last 4 decades, when, you know, during the 1970s, that inflation rush led to gold's price appreciation. But then we saw Paul Volcker come in during the 1980s, significantly raise interest rates to 15%. And we saw a lull in gold's price from 1980 to 2000. And so we do see that kind of more of those cyclical factors play into gold's price movements earlier on. And that's where sort of that negative correlation comes into play.
Hmm.
That observation of gold's rally in relation to the S&P 500 is a great question. And the answer is really, as I mentioned, central bank buying, geopolitical uncertainty. We're in a new world order that we haven't really experienced before. And that's what the market is grappling with. And when the market is grappling with those sort of considerations, they reflect that in something like in markets, and that happens to be gold's price. And so that's really the explanation. As I've mentioned before, the key question is, can the rally continue? And I think, again, it comes back to, does the market truly believe that this world order, the shifting world order that we're seeing ourselves in, is here to stay, and that debasement trade, quote unquote, is true? Otherwise, we might see a pop in gold coming a bit further from here. I'm no expert. It's very hard to forecast, but I think that in our view, at least, that you know the tension between China and the US is here to stay. We are looking, forward to what Trump and Xi decide at today's meeting in South Korea. But from what I can see, uncertainty is here to stay for some time. So.
Hmm.
Yeah, I'll leave off with that comment.
Well, that was fantastic. Thank you very much, Hugh. I think the content was great and the level of questions were reflective of that. It's a fascinating topic at all times and certainly right now. So again, I would encourage the participants to have a look at the Betashares products on gold. Betashares they're great. They're a local Australian ETF company, so it's a great option for evaluating a gold investment. But with that, I'll say thank you to Hugh and to Betashares for joining us today on the webinar. Thanks again.
Thanks very much for having me, Doug, and appreciate everyone tuning in.
Yeah, thank you.